Welcome to TheoTRADE. This is Don Kaufman. It's September 20th, 2023, just a few hours after the cash close here on this Wednesday afternoon. And of course, today being a Fed day, lots of action to cover in this evening's video. Did you fight the Fed? Well, if you did, it was unpleasant, of course, inside of today's activity. S&Ps, they sold off by the tune of about 1%. Even heavier sell-side activity specific to the Nasdaq. But again, it's not so much the S&Ps that are my concern right now, not even the Nasdaq. Let's push all of that aside for just a moment. And well, let's go to the main catalyst for the next couple of days of trade. It's going to be the bond market. That's just going to drive everything right now. And look, for those of you that are not necessarily familiar with bonds, or you're not necessarily familiar with notes, look, there's another way to look at this. Of course, we're going to look at the TNX, and the TNX is the interest rate associated, of course, with the 10-year. The reason I say that this is going to be the catalyst, okay, for everything in the next couple of days, few weeks, we are at the critical juncture. The TNX is right now kind of piercing through the highest level it has been. And, for me to open up a chart over here, look, you can go back 5 years, it's nowhere near it. You got to open up a max chart. You got to go all the way back to 2007 to see rates this high. But to me, that's not even like the cause for concern. Look, it was a different world back in 2007. It's cause for concern at this point, and what traders look at is the possibility of a significant break to the upside in this 10-year. And obviously that implies higher rates. But look, people, there's only so much that the marketplace can possibly take before, again, the S&Ps really start to melt down about higher rates. Moreover, the dollar continued higher again today. It almost came off this, what is just almost a vertical trajectory lately. It almost came off of it the last couple of days. Today, didn't matter. The Fed announcement, look, we could talk about the Fed till we're blue in the face. The Fed didn't do anything other than say what we kind of anticipated was higher rates for longer. Okay, another rate hike, the possibility is, well, extremely high between now and the end of the year. Again, some of the Q&A, though, really got the marketplace going. And again, the marketplace that I would look at that, as I said, was the catalyst for this. Take a look at the intraday of the ZB, because I think that this really kind of highlights it. The Fed announcement came out, well, right there. Obviously, you can see that pretty clearly right in the neighborhood here. That's 11 a.m. Pacific. We bounced, but as soon as Jerome Powell really started to talk, that was it, people. It was a roller coaster ride to the downside inside of none other than, again, the ZB. So the ZB is, that's more of like the retail friendly, quote unquote, tradable product. Now, again, we're going to push that aside for just a second. That's one of the primary catalysts. I think you just have to assume that in just the next few days to come, pay very careful attention to the ZB. If there's really any continuation to the downside, it's gonna put that fear specifically into tech. I mean, some of the tech stocks are already feeling the fear. Take a look at NVIDIA today. Took a fairly significant hit. I've been calling just this big round level. Look, 400 inside of NVIDIA is going to be a fairly critical level in there. Even more importantly and more appropriately, Microsoft is at the absolute critical level. I've been calling for Microsoft back to 320 for the last couple of weeks after it actually bounced higher. We took advantage of this trade all day long. We're actually still short Microsoft here. Microsoft at 320 level, I mean, it's like, really, it's like almost like a confluence of events that are going on right now. None of them are positive. And again, I think it stems a lot from this ZB. And by the way, if you're ever looking at the ZB and you're on thinkorswim and you're looking at the daily chart, it's critical. You got to come in here, go over the futures, adjust for contract changes, hit apply, hit OK. It's a contract adjusted chart because these little dashed lines over here are contract changes. And those contract changes, I mean, it would really mess up if you were using technical analysis and not adjusting for contract changes. I just want you to see that we've pretty much matched the lows on the ZB, and more importantly, again, on the ZN, which is the 10-year, we're through it. We're through it. The 10-year is, off in never land right now. And yeah, it's cause for concern because at this point, people look at this, they go, it's got to rebound unless it doesn't, unless we actually see a lot of traders recognizing, okay, that the short position in here is just boom, and we start going for the door and there's sell side activity and it gets brutal before it gets any better. And that's the kind of trade that you're seeing in here is, look, I've watched people call the lows in this ZB market, okay, throughout the entire last year. I mean, look, people have been calling the lows inside of the ZB now. Take a look at the 3-year. They've been calling for lows, since the ZB started really selling off. You realize we're from 173. There's a 3-year, 173 all the way down to 117. Now, I've been doing this a lot of years. Nobody has seen a move this substantial. And the cause for concern right now is, you're in the midst of what is one of the most wild bear markets inside of the bonds ever, right? And at some point, though, are you going to see wild degrees of capitulation? Because at this point, again, enough of people trying to call some of the lows in here, you could be in a serious capitulation type marketplace, start really selling them. It doesn't have to do with the interest rates at that point. It has to do with traders, and traders actually in margin calls, okay, and hysterics, okay, start spiraling out of control. Think about it. Again, because this is the catalyst right now for the marketplace. Now, as I said, I was bringing up tech, and tech, there's kind of a confluence of events going on when you start looking at stuff, as I said, like Microsoft, like NVIDIA. NVIDIA, 400's a long way away. Come on, it's 22 points away. It's one rough day. You start looking at products like Meta, okay, it's almost completely unscathed. That could actually be opportunistic. I looked at Google, okay, this is the first real hit we've actually seen in Google in quite some time. Also, very, very opportunistic. The reason I'm bringing up like Google and I'm bringing up Meta, when I say opportunistic, or something like Amazon, very, very opportunistic at this point, because if we're going down, these stocks are going to take huge hits. Huge hits. You're already seeing the hit inside of Microsoft. Apple, okay, it's been damaged. Okay, this is damaged goods at this point. NVIDIA, mild damage. Why? It's 80 handles. What's 80 handles amongst friends? But notice I didn't even touch Tesla over here. Opportunistic maybe, but dangerous to say the least. Nevertheless, the opportunity to me is in Amazon, Google, possibly Meta on the short side of that trade if we're actually going to break down. Now, let me also bring into scope a confluence of events just in the next couple of days of trade. For the next few days of trade, volatility is becoming interesting because the 15 level, I just want you guys to take a quick glance with me here. Again, I am no proponent of the VIX, but the 15 level, we're very close to where volatility could kind of break out. If it gets much above 15, you're a quick shot up to the 1920 handle easily. So keep that in mind, right? And the reason you want to keep volatility in mind is it's not so much about VIX, it's more about the SPX, the mother of all products, as we do each and every Wednesday. We look at the SPX, okay, in accordance to, of course, expected move. The expected move this week, and I'm just going to highlight and zoom in over here, the expected move this week is roughly $60. To be specific, it's 59.55, but expected move equals plus or minus roughly $60. Look where we actually closed. We're about 10 handles off the lower edge of the expected move. And the reason I said kind of a confluence of not such good events, especially if you're bullish in this marketplace, the real kick to this marketplace, yeah, the bonds selling off, right? Yeah, the S&P's coming down a little bit. The dollar, which is ready to break out. Interest rates, obviously, ready to break out to the upside. But the really big hit for literally Thursday and Friday this week would actually be the SPX coming outside the lower edge of its expected move. Now I want to give you specifics. This is SPX. This is not S&Ps, right? SPX, it's roughly 43.90. You start to pierce through 43.90, okay, and you're going to see volatility start to really rip higher at that particular point in time, because outside the expected move, things will get all kinds of crazy in this marketplace. Again, watch bonds the next couple of weeks, but in the next few days, yeah, you got to watch SPX volatility. Look, there's a degree and a hint, if you will, of volatility in the air following this Fed announcement. The Fed, again, they didn't say anything surprising. You know, and that's why I say, you know, why are you trying to fight the Fed out there? Did you continue to fight the Fed? Been raising rates. Now it's not about raising rates. Now it's about rates higher for longer. Keep that in mind, right? And of course, the next couple of days, watch this SPX expected move, because right now it is everything. This is the line in the sand, and that bond market really starts to rock further to the downside, and things could get wild in a hurry. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.